So welcome back, everyone, for today's lecture. We stopped last week with this final example for risk mapping. Again, a short recap. Remember what a risk mapping was. We have elementary risk factors that try to model the statistical behavior of those elementary risk factors that at the very basis drive risk. That could be interest rates, that could be macroeconomic variables, unemployment rates, interest rates. It could be default rates, and these risk factors, they need to be combined to form the distribution, the statistical behavior of the financial profits and losses. We need the loss distribution in the end. Now, in a very basic and very simple example of a stock investment, we only had the stock price driving risk of a stock investment. And this final example is a little bit more complicated. We have a portfolio of loans. A loan is nothing but simply an amount of capital given from company A to company B, or from household A to household B, etc. So from this theoretical point of view, a loan is the same as a bond. You can regard the same as similar. So later on we'll see the pricing. The valuation of these loans is close to the valuation of the bonds we've seen in the example before. So we don't have a bond portfolio, but now we have a portfolio of loans. The difference is, in the example of the bond portfolio, we assume that the bonds were free of default risk. They were risk-free. In the loan portfolio, it is clear that we are not only exposed to interest rate risk, but we are also exposed to default risk. And that is why we need to include default rates, default probabilities as additional risk factors. So let's turn to this example. We have an investment in loans. We have default risk. We have interest rate risk. We are looking at a portfolio of loans with M counterparties. The nominal value of the credit to the ith borrower is EI. E stands for exposure. Delta is set to 1 year, a very common assumption in credit market and credit risk management, that you're only looking at a 1 year horizon. What is the probability that your borrower defaults within the next year? We assume that our loans will be repaid at time capital T larger than T, so there is still some time left on each loan, and that there are no early partial repayments. Then let YTI be a random variable that takes the value 1 if the borrower has defaulted in the period 0 up until T, and the value T otherwise. YTI is a dummy variable. So 1 if default, 0 otherwise. It's a dummy variable because it can only take the values 1 and 0, and the value, sometimes we also call this an indicator variable. This variable indicates whether loan I has defaulted in the period between 0 now and a future point T. That's a default indicator variable. For simplicity, we assume that the recovery rate of the loans is 0. What is the recovery rate? Now, empirically, you would be surprised to see that empirically, if you have 1 million euros in loans outstanding and all of these borrowers default, actually the average bank or the average lender will be able to recover 70 to 80%, no, they will recover 20 up to 40% of these loans. And if you have a loan, you can sell it. You can sell it to a specialized company that specializes in retrieving money from defaulted borrowers. In German, if we were to say it with a little bit of humor, we would say Moscow Inkasso. You sell it to also sometimes bad banks. A bad bank, by definition, is a bank that has specialized on retrieving and recovering money from defaulted borrowers. And how do they do this? They contact the borrowers frequently. They make them offers that, for example, you have a debt outstanding of 10,000 euros. If you pay 3,000 euros, we will refrain from any further action. So these are some methods you can use to recover your money from defaulted lenders, borrowers. But in this case, we'll assume the recovery rate is 0. So if someone defaults, all is lost. It's 100% loss on a defaulted loan. Now we start with the evaluation of the loan's cash flow. Since the loan is exposed to default risk, we have to discount the cash flow, EI, with a risk-adjusted interest rate. Not just the risk-free rate, but the risk of the loan is higher than the risk-free investment. More specifically, we use the risk-free interest rate, which is the yield of a risk-free zero coupon bond standardized to the notional value of 1. Remember this. We use standardized zero bonds. Then the yield on a standardized zero bond with a notional of 1 is the discount factor. So the value of the loan at time E is given by. Also, for simplicity, we assume we only have one payment, EI, the exposure. We have a 1,000 euro loan, and in 1 year, it's paid back. So you take the cash flow times the discount factor. This is the cash flow. And this here is the discount factor. That's the cash flow, that's the discount factor. It looks a little bit complicated, only for one reason. You need, remember, in continuous with continuous compounding, you have exponential function of minus r times t, the maturity. Now in this case, r is the risk-free rate plus a risk premium, and capital T, the remaining time until maturity, is capital T minus T. In other words, the value of this loan is nothing but the exposure, aka the payment, the notional payment, discounted continuously with Y, that's the yield of the zero coupon bond, that's the risk-free rate, plus CI, and CI is the risk premium, that's the credit spread. Why is the risk premium here called a credit spread? What is a credit spread? Generally, if you look at corporate bonds will give you an interest rate, will have an internal rate of return that is higher than the risk-free rate. For example, let's assume, for Deutsche Bank, you can calculate an internal rate of return of 3.15% it is paying on its bonds. If you know that the risk-free rate is 1%, the spread, the difference between the rate of return on the bond, on the corporate bond, and the risk-free rate, this difference, this credit spread, is the risk premium you have to pay on top of the risk-free interest rate for credit risk. That's 2.15% is the credit spread. And this is obviously the extra you would need to use here in the risk-adjusted interest rate. That's the credit spread, and credit spreads can be extracted from corporate bonds. By the way, credit spreads have been used frequently in empirical research in finance. Why and how? What good are credit spreads for? If, for example, you have Deutsche Bank, you have a company, and you can observe corporate bonds on the market, and you can calculate, using rather sophisticated methods, you can calculate the credit spreads for Deutsche Bank. What can you do with them in research? First of all, you can compare the time evolution of the credit spreads. If you see that credit spreads for a company are increasing, it means that the market's impression of the credit risk of this company is increasing. And also, you can obviously compare it with other companies. You can see that maybe credit spreads for Deutsche Bank are higher than those for Commerzbank. And this will tell you that if the credit spread is higher, the market participants think that company A is exposed to higher credit risk and has a higher default risk. It's not exposure to credit risk, but it's its own credit risk. It's a default risk. That, for example, Deutsche Bank has a higher default risk than Commerzbank. That is why, dating back decades, financial research has frequently used credit spreads to measure default risk of companies. However, credit spreads are not the best instrument to proxy for default risk. An even better way of measuring credit risk and default risk are so-called CDS spreads. What is a CDS? Does anyone know what a CDS is? A credit default swap. A credit default swap is an OTC trade. Well, it's not traded, but it's an OTC instrument that is similar to a default insurance. Let's make an even one step back again. Does everyone know what an OTC financial contract is, in contrast to an exchange-traded contract? An OTC contract is a financial instrument that is agreed upon by two market participants without including a financial intermediary like a bank or especially like an exchange. Now I can buy let's make an example with a stock. I can buy a Daimler stock from you via a stock exchange. If you are the stock exchange, I will buy one stock, you will sell one stock, I will buy it via the exchange. If you default, the stock exchange guarantees payment and delivery. So that's one function of an exchange. It will regulate market entry. It will make sure that you have enough cash and you have the stock and that I have enough cash. And then it will guarantee that if I want to buy and you want to sell, that this trade is done and the transaction takes place. If you default, I still get my stock, but the stock exchange will most likely kick you out of the market. Right? In an OTC contract, I can buy it directly from you, but there is no guarantee that if you default, I will get my stock. And the stock exchange obviously also not only guarantees payment and delivery, but it also makes it easier for the two of us to find each other. In an OTC market, in an OTC contract, I need to find my counterparty. Now, why do I want to engage in an OTC contract? Because in many cases, I know the major players in my market. If I am, for example, E.ON, I know that RWE is a large competitor. I know the select number of market participants that are willing to enter an OTC contract with me. Deutsche Bank knows all other major banks in the world. So then, if you know, it's only a select small group of market participants, of institutional investors. The advantage of an OTC contract is that you can agree to very specific contract details. On an exchange, everything is standardized to facilitate trading. So an OTC contract, a CDS, credit default swap, is an OTC contract. What does it do? Simply, you swap credit risk. Best example, if you've seen this, The Big Short. A fund manager goes to JP Morgan and says, I want to buy credit risk insurance against these instruments, against these funds. JP Morgan says, we are willing to sell you protection with a notional of, say, 300 million euros for a price of, say, 3%. Meaning that, in this context, I'm the buyer of the CDS, you are the seller, and you are the reference entity. You are Deutsche Bank. I want to buy insurance against the default of Deutsche Bank. You are an institutional investor or an investment bank, and we are agreeing on a credit default swap. I'm paying, let's say, a CDS contract with 100 million notional, 100 million euros for 5 years. If Deutsche Bank defaults within the next 5 years, you will have to pay me 100 million euros. In other cases, if Deutsche Bank does not default, I will pay you, say, 3% yearly premium on those 100 million euros. And this 3% I'm paying you for the insurance, that's the CDS spread. If the entity, reference entity, is highly close and very close to default, I might be forced to pay 15% or 10%. If Deutsche Bank will never default, is completely risk-free, the CDS spread will just be a little bit above 0%. Why are CDS spreads a better proxy for credit risk and default risk than credit spreads? Credit spreads are extracted from bonds. Bonds are investments that are meant to invest in a risk-free investment plus something on top. You are investing in a company. In a CDS contract, you are betting on the default or non-default of a company. And to extract the credit spreads, you need quite elaborate and sophisticated interest rate models. And it's not so straightforward to extract those credit spreads. With a CDS spread, the CDS contract is only meant to insure against the default of the reference entity. So the CDS spreads is a much clearer proxy for default risk. Is that clear? I'll say this in German, because I think this is important from a research standpoint. Sie können Credit Spreads und CDS Spreads beide als Proxys, also als Näherungsgrößen für das Ausfallrisiko eines Unternehmens nutzen. Das wird in der Literatur gemacht. Die CDS-Kontrakte sind aber noch nicht so alt. Deswegen früher in den 80er, 90ern hat man immer nur Credit Spreads genommen, um Ausfallrisiko zu messen für ein Unternehmen. Wenn Sie wissen wollen, wie hoch ist die Wahrscheinlichkeit, dass Douglas oder ich weiß nicht, Deutsche Bank, Commerzbank pleite geht. Credit Spreads sagen Ihnen etwas darüber aus, was denkt der Markt über das Ausfallrisiko dieser Unternehmen. Das Problem ist, Credit Spreads werden aus Anleihen, aus Unternehmensanleihen extrahiert. Die rechnen Sie aus mit relativ aufwendigen Zinsstrukturmodellen. Aber diese Bonds, diese Unternehmensanleihen werden ja nicht gekauft, um nur aus dem Grund, weil man in Kreditrisiko investieren möchte, sondern in diesen Unternehmensanleihen und in der Verzinsung und den Preisen stecken auch Erwartungen des Marktes hinsichtlich der zukünftigen Zinsentwicklung. Deswegen ist das bei Credit Spreads nicht so ganz klar, wie viel ist da jetzt eigentlich Annahme über die Zinsstruktur und wie viel ist da wirklich auch eine Annahme und eine Erwartung hinsichtlich des Ausfallrisikos. Bei CDS-Kontrakten ist es eindeutig, da investieren Sie ja kein Geld, Sie kaufen nur eine Versicherung. Deswegen sind CDS-Spreads immer eine etwas saubere Möglichkeit, um Kreditrisiko zu messen. Problem ist, es gibt deutlich mehr Unternehmensanleihen als CDS-Contracts. Und das ist ein OTC-Markt, der ist etwas intransparent. Da muss man sich darauf verlassen, dass alle Marktteilnehmer auch wirklich ihre vereinbarten Kontrakt- und Vertragsdetails so veröffentlichen. So, und wieder was dazugelernt an der Stelle. Nicht nur einfach hier, was ich alles so hinter CI verstecken kann. 10 Minuten Vortrag. Okay, gut. Jetzt switch back to English. Let me erase some of my paintings here. The value of the loan is nothing but the exposure, the notional, discounted continuously with the risk-adjusted interest rate, that is risk-free rate plus credit spread. Okay, next. We further simplify this model and assume that we have a homogeneous portfolio where the default probability is equal across all borrowers. That is, the credit spreads are all identical. Is this a sensible assumption? Well, banks will usually try to form homogeneous portfolios, especially in retail banking, because they want to use models that are as simply as possible. And if you assume that the credit spread is equal and borrowers all equal, then the model will become simpler. Then we don't have an idiosyncratic, by the way, that's the English word, idiosyncratic, we have the same in German, but idiosyncratic means firm specific, specific to the individual. And CI is the idiosyncratic credit spread, and we now change that to a constant credit spread that is common and equal for all the banks. In summary, we then get for the value of the credit portfolio, VT, the sum of 1 minus YTI, the indicator variable, times exposure times the continuous discount factor. Now, can someone explain to me this? What is this? Yeah?
The value of the credit portfolio is 0 if the person is defaulted before.
Yeah.
And it's 0 if the YTI is 1, as we saw 2 slides.
Yeah. Y is 1 if the borrower has defaulted. Then we have 1 minus 1, so 0 times the discount factor, so the value of that particular loan is 0. We sum it all up and we get the value of the whole portfolio. And then we can summarize the risk factors into an n plus 2-dimensional random vector. We now have which random factors? The default indicators, aka the default probabilities for all borrowers, the risk-free rate, the yield on the zero coupon risk-free bond, and the unique and equal credit spread that is constant. So the loss LT plus 1 as well as loss operator are based on this vector of risk factors. And we do not simply have the risk-free rate and a credit spread. We could also enlarge the model by using idiosyncratic credit spreads. And we need the default probabilities. Okay. Now, even in this very simple model, we can see that the portfolio value depends on the joint probability of default. And this is something you should always remember. In statistics, you differentiate between the marginal distribution and the joint distribution of 2 or more random vectors and random variables. In German, die Rand- oder die Grenzverteilung and the joint distribution, die gemeinsame Verteilungsfunktion. Could be that if I take 2 dice, or 2 die, 1, 2, I think, is dice or die the plural? Dice. 1 die, 2 dice. If I take 2 dice, throw them in left hand and right hand, it could be that they have a uniform distribution. 1, 2, 3, 4, 5, 6 with the same probability. But could still happen that the 2 hands are completely independent, but it could also be that every time I see a 1 in the left hand, I throw a 1 in my right hand. The result will be that still both dice could be distributed according to a uniform distribution, but the joint distributions will be different. And here, with default probabilities, obviously, this is also very important. If, for example, you have a portfolio of independent loans, it means that if you default, it doesn't change a thing about your default probability. But also, in many cases, you have two scenarios, at least two reasons why your distribution, your default probabilities could be connected. And this brings us to my favorite topic, at least in empirical banking and finance, difference, causality, correlation. Now let's assume you are X and your neighbor is Y. Now you are loan 1 and you are loan 2. If your two default probabilities are independent, your correlation will be 0. Rho will be 0. No correlation, no dependence between the two default probabilities. Now, give me two different scenarios why your default probabilities could be correlated. And this is also related to causal analysis in economics and especially finance and banking. Because you could make the same case. You have two variables, X and Y. You want to explain Y using X in a regression analysis. And correlation doesn't tell you anything about causation, causality. How and why could X and Y be correlated in practice? Yeah?
For example, if both assets are correlated, like, for example, gold and
Let's stick with two loans. We have two private households. And I'm a bank. I've given out two loans to the two fellow students. Why could the default probabilities be correlated? If, for example, you have two businesses and your business depends on the success of your business. In a more corporate context, you are Volkswagen and you are Bosch and you are a major supplier of equipment to Volkswagen. If Volkswagen defaults, you will have problems as well because one of your major customers has defaulted. Meaning, the correlation stems from a dependence running from X to Y. Could be other way around. If, for example, Bosch defaults, Volkswagen can no longer produce as many cars as they would like to because they are lacking intermediate products and equipment. And then there could be something going on as well. In empirical banking, this is my favorite example with storks bringing babies. And this is also called spurious correlation. Because if we measure correlation between X and Y, in any case in economics, in any scenario of empirical research, one is inclined to think that X drives Y or Y drives X. But could be that Z drives X and Y. If you are two companies, again, Volkswagen, Bosch, and if I am the state, if I increase taxes, both of you will have a problem. If I suddenly argue that it could also be, if, for example, I'm a manufacturer of tires, and if I default, Volkswagen will have no tires, it will stop production, and you will have a problem because now Volkswagen, again, causes you to have a problem. Best example for this is probably weather effects in insurance. You might know this, that if you have car insurance and if you have bad weather in some parts of Germany and the cars are parked outside, that's what is called a cluster risk. Many cars will be affected, not because car A is driving into car B and has an accident, but there is something that affects both at the same time. Es in empirischen Analysen zur Scheinkorrelation. Das ist das schöne Beispiel mit den Störchen und den Babys. Wenn Sie das untersuchen, Störche bringen Babys. Haben Sie eine Korrelation. Mehr Störche, mehr Babys. könnte man auch andersrum sagen, mehr Babys, man könnte argumentieren, mehr Babys, weniger Störche. Das finden Sie aber nicht. Die Korrelation ist positiv. Was ist es? Industrialisierung. Industrialisierung, je industrialisierter ein Land ist, desto weniger natürliche Habitate für Störche gibt es, desto weniger Babys werden geboren. Und dann ist das eine Scheinkorrelation. Und das Ähnliche hätten Sie hier eigentlich auch. Wenn Sie zwei Unternehmen haben, entweder die sind direkt miteinander verbunden oder es gibt eben einen Einfluss, der bei beiden irgendwas hoch oder runter treibt. Und das ist genauso wie in der Versicherungswirtschaft mit Kumulrisiken. Ne? Ein Hagelschauer. Wenn der im Landstrich hergeht, dann sind alle Autos betroffen. Es muss nicht die Wahrscheinlichkeit sein, dass zwei Autos einen Autounfall haben. Okay, so you need the joint distribution. You need to model those risks, those dependencies between the default probabilities to get a better and clearer picture of the risk factors driving credit risk. And we'll discuss this later. Any questions on this example of a loan portfolio? No. Then let's turn to risk measurement. And we'll start with some principles of risk measurement and then turn to axiomatic risk measurement theory, something that comes from mathematical finance to us. And I'll show you some of the basic results for which we don't need too much mathematics. So we've dealt with various risk factors. We know that we need a first good understanding of what factors cause risk, how the interplay between those risk factors is, and how loss distributions come into play. And in this chapter, we'll now deal with the question how and with which metrics should we measure risk if we are given a loss distribution. So we have L t plus 1, and we want to estimate a function of the loss distribution. The simplest idea could be to take the mean loss, the expected loss, an average loss. In our examples, we've already seen the Black-Scholes option pricing model, and I told you that actually in practice, investment bankers much more like to use the Greeks rather than option prices, because the Greeks are nothing but sensitivities of the option price to changes in the Black-Scholes model parameters. So this could be one way to measure risk. Problem is, factor sensitivities are what they are sensitivities. They are percentage changes, and ideally we want a proxy, we want a metric that is given in dollars or euros in a monetary unit. And yeah, in many areas of risk management, we are doing all of this for risk capital allocation and for supervisory purposes. So we need a monetary expression for risk. We want to know if we are exposed to 50,000 euros loss or $1 million loss. So factor sensitivities are not the best way to measure risk. However, one way to do this is scenario-based risk measures. And this is an example I've taken from the, I think, Hong Kong Stock Exchange. Yeah. We consider a set xi of x1 to xn of risk factor changes. Remember that x1, x2, x3, these vectors, these were changes in risk factors. And we are using a weighting vector, w. So let there be an arbitrary risky portfolio with an associated loss operator L. Then we can estimate and we can measure the portfolio risk by entering the different risk factor scenarios, weighting them, and then taking the maximum of this. What would this mean? For example, I would assume that in case I only have a risk-free interest rate as a risk factor, I could argue that I'm looking at these scenarios. I will enter these scenarios into my loss operator, which would mean, for example, loss is 0, loss is 0, loss is 1 million, and 2.5 million, and maybe 3.1 million. Then I would weight these scenarios, maybe 10%, 20%, 30%, 20%, 20%, and then I'll calculate the different losses, take the maximum of the weighted losses, and that's my risk metric. That's my risk measure. This is a scenario-based analysis. We'll see this in a different way later on when we talk about backtesting and stress testing. But that's a very simple idea and very simple framework for measuring risk. Simply calculate some scenarios. These are, for example, used by the Chicago Mercantile Exchange or the Hong Kong Exchanges and Clearing to determine margins. Who can explain to me what a margin is? I think I have it on one of the earlier slides. What is margin? And a margin account with an exchange. No one? There's one also very good movie on the financial crisis that is called Margin Call. What is margin? No idea. If you are a trader on an exchange, could be a mercantile, could be a futures exchange or a stock exchange, you have an account with the exchange. And if you are trading, it might be that you are piling up losses. And the exchange will have rules in place that at some level of losses, you need to balance your account, you need to make a margin payment and make a payment into your margin account. That is called a margin call. To guarantee that you're not piling up too extensive losses on your account with the exchange. Meaning that the stock exchange or the futures exchange will have to estimate, they will need to compute and calculate the amount of cash that is required of traders to keep in their margin account. And how do they do this? They estimate, they make a risk forecast. How much risk are these traders exposed to? They make a scenario analysis, usually arguing that what would happen if the trader loses 5%, 10%, 15% on its next trade, etc. So where a client, that's the documentation of the Hong Kong Exchange and Clearing, where a client maintains a margin account with the exchange participant, he will be required to pay margin on both long and short positions based on the standard portfolio analysis of risk, SPAN, margin methodology. SPAN is a risk-based portfolio approach for calculating the daily margin requirement, which has been developed by the Chicago Mercantile Exchange. SPAN simulates how the portfolio would react to changing market conditions. Obviously, the risk exposure of a futures position is the futures price movement. For an options position, apart from the price risk, changes in volatility also act as another major factor in affecting its risk exposure. Therefore, SPAN evaluates the risk exposure of a portfolio by varying these two factors. So they are looking at scenarios where the option, the volatility and the underlying price change. And they come up with different scenarios. They enter it into the Black-Scholes model, and then they see how an options position would change in value. And to see what the entire portfolio might reasonably lose in the following trading day. And then based on this risk forecast for the next trading day, you will have a margin call. You will be required to pay additional cash or nothing into your margin account. That's SPAN. However, one problem of scenario-based risk measurement is that the selection of scenarios may turn out to be difficult, and to some extent it's completely arbitrary. You choose the scenarios, and who tells you which scenarios to choose? So that might be difficult. So in the following, we'll do what most practitioners and most risk management models do. We concentrate on statistical loss distributions estimated from historical data. So in general, almost all quantitative risk models measure risk using statistical loss distributions. And you do this by taking moments from those loss distributions. So the idea of using a loss distribution and moments thereof is sufficient to adequately reflect the risk of an investment can be justified as follows. First of all, moments of statistical loss distributions give you metrics in monetary units. Those are monetary figures, and that's good because we can do risk allocation and risk capital allocation with this. You can aggregate loss distributions. You can take X and you can take Y. If you have two random variables, you can sum them up and get a new random variable Z. You can account for netting and diversification effects, and you can compare loss distributions. If you have two distributions, 1 and 2, you can compare them. With scenarios, that's a little bit more difficult. However, you have two disadvantages. First, you need to choose the right model, whether it's a Gaussian distribution, a Stevens T distribution, a Pareto exponential distribution, etc. However, that only tells you and tells the risk manager, choose wisely. You need to care about model risk. Second, you need historical data to estimate the loss distribution. If you have no data, if you have garbage in, garbage will come out. So the disadvantages of using loss distributions are no real disadvantages, but only reminders to be careful about model risk when it comes to data and choosing the right model. Now, the use of a loss distribution is obviously not yet sufficient to model risk. You need moments, you need metrics based on loss distributions. So you will use key figures, ratios, individual values, or moments, statistical moments of a loss distribution. And then you have different metrics that can be better or not better for your use in risk management. And for this, we need axiomatic risk measure theory, Risikomaßtheorie. If you're studying mathematics, you will immediately see that this comes directly from measure theory and integration theory. So let's talk about axiomatic risk measurement theory. The theory of risk measures, the mathematical theory, dates back to one famous paper from 1999, published in 2000, in Mathematical Finance by Arzner, Dilbin, Eber, and Heath. Those are financial mathematicians. And they came up with one paper. It's called On the Coherent Risk Measures. That's what it's called. And the basic idea was, in mathematics, you have a fine theory of mathematical objects, of coming up with measures for the distance between those mathematical objects and requirements on how you can measure mathematical objects, functions, numbers, sets, etc. And what they did is they realized that everyone in risk management was using loss distributions, in other words, random variables, Zufallsvariablen, and they calculated metrics of random variables, but there was no restriction on which metric you should use and which metric you should not use. And they came up with some axioms, in German, sehr schön, unbeweisbare Grundtatsachen, something you are requiring but you cannot prove, something you are requiring from the very start, and risk measures that are sensible in an economic way, they should adhere to these axioms. And only those risk metrics should be used that adhere, that fulfill all of these requirements. And we'll see that some very interesting risk measures are actually not coherent under this definition. I'm not discussing all the mathematics behind this. In the paper, it's a very nice idea. They start more or less from geometry, from the geometry of the set, from the space of admissible random variables, of admissible risk, and they argue that a regulator, like God, decides which risks are acceptable and which are not. So all the risks are divided into two sets: acceptable, non-acceptable. And we are now looking at a function that decides, that tells you this risk is acceptable, this is not. And then they use geometry, they combine geometry with the theory of random variables and integration theory, and then at some points they get these results. So if you're studying mathematics, this might be very interesting to you. It's not really for me. And again, we'll start with risk measures being random variables on a probability space. Zufallsvariablen auf einem Wahrscheinlichkeitsraum. We denote with L0 the set of all the random variables that are finite almost everywhere. This is a formal requirement. You do not need to memorize this. If you're not studying mathematics and if you have no background in probability theory, just for your information, almost everywhere or almost surely in these papers, sometimes abbreviated AE or AS. In German, FS oder FÜ, fast überall oder fast sicher, is what? It's a property that does not need to be fulfilled everywhere, but almost everywhere, meaning with probability 1. It might be that you still allow this event to be, well, not possible. It's not excluded, but it makes things easier technically in mathematics if you just assume that, yeah, could still happen, but only with probability 0. There's a fine philosophical distinction between something being impossible and something being possible, but with probability 0. So this is why we are looking at random variables that are finite, endlich. So we are infinity, plus infinity and minus infinity, they are thinkable, but only have probability 0. Okay. Then we assume that M is a convex cone, that is, for two risks, aka random variables, the sum and a positive scaling of a risk, again, are an allowed risk. What does it mean? We have this set of risk. Let's assume these are stock investments. Each stock investment is a risk. A convex cone means if we combine two stocks into a portfolio, the portfolio is still an investment we can invest into. And if we buy one stock, we can buy 5 stocks and we can buy 10 stocks. We would still get risk. This seems to be theoretical, but think of it this way. If mathematically you were not requiring this, you could think of a market where you have two individual risks and the combination of these two risks would not be possible. But it should be possible, so the risk should be a convex cone, convexer cone. Is that clear? That's the only thing geometrically we need today. So what is risk measure? A risk measure is a real valued function, nu, from the set of admissible risks into the real numbers. We have a stock investment x1 and x2, and if we say -5 minus 8, these are the risk measures, or actually the risk values, and this function nu is the risk measure. Das ist das Risikomaß, eine reellwertige Funktion auf der Menge der zugelassenen Risiken, also auf der Menge der Zufallsvariablen, die so einen konvexen Kegel, genauer gesagt, nicht Kon, einen konvexen Kegel bilden. So far, quite simple. You have random variables, that is risks, and if you relate each risk to a real number, then it's a risk measure. And we interpret this risk measure, mu of L, as the capital sum, which must be allocated to risk L so that it is perceived as acceptable by an internal or external decision maker regulator. Could be your CEO, could be the risk manager, could be the supervisor, could be God, or the gods. If the risk measure is negative, the risk is acceptable, and the amount of minus the risk measure can be withdrawn from the position without the risk being perceived as unacceptable by the decision maker. Think of it as your savings account. If you have 5,000 euros in your savings account, you have no risk, but you can withdraw 5,000 euros from your savings account before it becomes unacceptable for the bank, for example. In some cases, you have investments where you have additional cash, additional capital, and then the risk measure, by definition, is not just a metric that says that's a risk that has 5 million loss potential and that has 0, but it might also be that the risk measure function tells you, well, you can still take 1 million out of this position and still the position is acceptable. That's an important fact about this definition of risk measures here. So next, the first axiom, translational invariance. The risk measure nu is translational invariant if for all risks L and each number small l, the following applies. Nu of L plus L equals the risk measure of L plus this number L. What does it mean? If we have a position that is that has a risk exposure of say 5 million, and we have 5 million in the bank, then the combined exposure is 5 million plus 5 million. Well, that's in this case. Huh? What does it mean? Translational invariance means, generally in mathematics, if you have an object and you move it in space, simply by moving it will not change its form, its structure. This is weird. One would think, why, if I move something, why would it change its form? You have to think a little bit out of the box. Here we have a random variable. And if we have a random variable that has risk exposure of 5 million, and we put 5 million into this position, then we have minus 5 million needed cash plus 5 million available cash, so the joint position will have 0. So that's fine. But if the risk exposure is 5 million, we do not need 4 millions or 6 millions to hedge this. And I'll give you one example where translational invariance is not given. If you have, for example, computer graphics, if you take a 3-dimensional room and display it on a computer or a beamer like this, in pictures, you have a picture or a computer screen that is in 2 dimensions. But if you look into your screen, if you look into your computer screen, computer graphics transforms a 3-dimensional object and to a 2-dimensional plane, to the 2-dimensional plane. And if you were, for example, if you do something here and you were to move it on the screen from to the back to the front, the computer will transform the object so that it will appear smaller or larger on your 2-dimensional plane screen. Überall in der Computergrafik und in der Fotografie wo Sie in der Perspektive arbeiten, wo Sie also letztlich etwas Dreidimensionales auf 2 Dimensionen transformieren, haben Sie das nicht. Das ist genau der Unterschied hier zwischen dieser Geometrie, so wie Sie hier haben, und zum Beispiel in der Computergrafik. Da müssen Sie natürlich Objekte, wenn Sie sie verschieben, maßstabsgetreu verändern. Sonst klappt das nicht von 3 auf 2 Dimensionen. Und hier ist genau die gleiche Idee. Translationsinvarianz heißt gerade, wenn Sie ein Risiko, eine Zufallsvariable haben und Sie haben irgendwo anders 5 Millionen rumliegen und Sie packen die 5 Millionen auf dieses Risiko, in diese Position, dann wird auch das Risikomaß, das benötigte Kapital nur genau um 5 Millionen verändert. Nicht um 6, nicht um 4 Millionen. Das ist die Translationsinvarianz. Then, subadditivity. The risk measure is subadditive if for all risk L1 and L2, for any set of 2 arbitrary risks, the following applies. Risk measure of L1 plus L2 is smaller or equal than the risk measure of L1 plus L2. What does it mean? In one word, diversification. If we have 2 investments, stock 1 and stock B, both have 5 million risk exposure. What risk exposure should the portfolio have? 10 millions at maximum. And because of diversification, hopefully, the risk exposure of the portfolio will be smaller than the sum of the 2 risk capitals. That's subadditivity. Positive heterogeneity. The risk measure is positively homogeneous. Not heterogeneity, homogeneity. Is positively homogeneous if for all risks L and all lambdas the following applies. The risk capital, let me just talk about this as risk capital. The risk capital of lambda times the risk is lambda times the risk capital of the original risk. What does it mean? It means that it doesn't matter if you buy 1, 5 or 10 stocks. If you buy 10 stocks, you have 10 times the risk. If you buy 50 stocks, you have 50 times the risk. And you need 50 times the risk capital. This is not trivial. In practice, one could argue that you have positive homogeneity up to some point. If you buy too much, because of liquidity concerns, it might be that your risk increases disproportionately. And risk measure is monotonous if for all L1, L2, with L1 smaller than L2, the following is valid almost surely, fast sicher. Risk capital of L1 is smaller or equal than the risk capital of L2. That means, if, for example, you have a situation, loss distributions. Let's use a loss distribution. This is L1 and this is L2. Which risk is worse? Which risk is worse? Obviously this one. Higher losses in any scenario. Then obviously we require the risk metric for L2 to show a higher needed risk capital than for L1. And that's the focal point here. L1, any L1, L2, any 2 risks, L1 and L2, but we require that L1 is smaller or equal than L2 almost surely. If the situation had looked like this, then we could not make any statement on this. Remember, we're talking about random variables, and you cannot simply compare random variable with random variable. If you compare a random variable with another random variable, that means that you need to compare all the values in any circumstance, in any scenario. And this is obviously a case where you can say, yes, L1 is definitely smaller or equal in any circumstance, in any situation than L2. This, no. Yeah, we have some points where, yes, L1 is smaller, but then it's different. So you need this to hold here, almost surely. And then, only then, you can say that the risk metric should also reflect this. Klar geworden? Sie können ja Zufallsvariablen nicht so ohne weiteres vergleichen. Zufallsvariable ist ja nicht eine Zahl, sondern es ist viele Zahlen, beschrieben dann durch die Verteilungsfunktion. Und dann müssen Sie eigentlich die Beobachtungen in allen Zuständen miteinander vergleichen. Und nur dann, wenn N1 überall, immer, in allen Zuständen kleiner gleich L2 ist, dann ist das hier erfüllt und dann sollte das Risikomaß natürlich auch einen höheren Kapitalbetrag ausweisen für das schlimmere Risiko. Aber nicht, wenn das eine Risiko mal schlechter und mal besser ist als das andere Risiko. Dann können Sie keine Aussage treffen. And now, a risk measure that fulfills axioms 1, 2, 3 and 4, that is called coherent, ein kohärentes Risikomaß. Positive homogeneity, monotonous, translational invariant and subadditive. Those are the 4 requirements for a coherent risk measure. And one would think that this is highly theoretical. Well, it's highly theoretical, but there are some very interesting results to it. Now, one step back. Remember, I told you that the risk measure is ideally positively homogeneous, meaning that if you buy 10 times the position, you have 10 times the risk. Problem is that with liquidity concerns, at some point one could argue that this is a too strict restriction. So let's loosen it up. We can only require convexity instead of homogeneity and subadditivity. So a risk measure is called convex if for all L1, L2, and a lambda between 0 and 1. The following applies. The risk measure of the convex combination is smaller or equal than the convex combination of the 2 individual risks. Then it's called a convex risk measure. We don't need this, but I wanted to include this for completion here. Completeness. Why do we need this? First of all, it was the first time in 2000 or 99 that someone looked at different risk metrics and risk measures from a theoretical point of view. Before that, everyone just used his or her own risk metric, and there was no way to tell which metric had an advantage over another one. The nice thing is also that it combines results from mathematics and this economic idea of measuring risk by the needed risk capital to hedge an investment. And last but not least, the mathematicians working on this field, they found that some very popular risk measures are actually not coherent. And it led to the development of additional risk metrics that are used by regulators nowadays that are, in contrast, coherent. So let's look at some of these risk measures. Let's start with volatility. Volatility is non-negative. Thus, by definition, is not a proper risk measure according to Arzner, Delbin, Eber und Heath definition. Out. The mean loss. The mean loss is very general. Variance, same problem as with the variance. Maximum loss is far too pessimistic. So we have several disadvantages too. The mean return, the mean loss, the variance, standard deviation, and so on. So people, banks, and companies came up with the so-called value at risk. And if you remember only one concept from this whole class of risk on risk management, it must be valued risk. What is valued risk? Valued risk came into existence by JP Morgan. JP Morgan offered in the 90s offered a program, a tool called credit metrics, with which banks were able to estimate and forecast the credit risk in their portfolios. And in this program, in credit metrics, you were given a figure that was called value at risk for your portfolio. And the value at risk was meant as a monetary number that tells you, well, how much money is at risk because you're invested in this position. Because almost all banks then started to use this program to adopt this metric, at some point, regulators and supervisors said, well, if everyone's using it anyway, let's make it official. Let's require it from banks. In Germany, it was part of the Grundsatz 1 supervisory rules. It has been incorporated into solvency regulation, Basel II, Basel III, and so on. And since the 90s, it has become the industry standard of a risk metric in banking and also insurance. However, and this was a big surprise at the end of the 90s, although every bank uses it, and it's such an important risk metric, Arzner, Delbar, Eber and Heath showed that the value at risk lacks subadditivity if it's used on non-elliptical distribution. So if it's used on a Gaussian distribution or a T distribution, it is subadditive and coherent. But every time you're using a different distribution, subadditivity is no longer given. So it's not coherent. That's problematic. How is the value at risk defined? We'll start with a portfolio of risky assets. We have the distribution function. So what is the value at risk? It can be interpreted as the loss that is exceeded with a certain fixed probability of usually 1%, 0.1% or 0.01%. Definition with a more formal mathematical notation is the infimum of the loss L such that the probability that the loss exceeds this number is smaller or equal than 1 minus alpha. That's the alpha percent value at risk of this loss distribution. This is correct. However, probably you have no idea what I'm talking about. So let's look at a profit and loss distribution. We have profits here and losses here. What is the value at risk for, say, alpha equal to 1%? It's just the 1% quantile. You have 1% probability here, 99% probability here, I practiced in the lecture before today. Nice. And this here, this point on the x-axis, that's your 1% var. You can see that for a loss distribution, it looks like this. The value at risk will be here. You have 99% here and 1% here. So this here is the 99% var. So again, it depends on whether you are looking at a loss distribution or a profit and loss distribution. Meaning, it's just a quantile. Der Value at Risk ist nichts anderes als ein Quantil der Verteilungsfunktion, der Gewinne und Verluste oder einfach nur der Verluste. Das ist die feine, mathematisch saubere Definition des Quantils. Aber das ist ein Quantil. What does the value of risk tell you? It tells you that this value is exceeded in 5%, 1%, 0.1% of all cases. So how would you interpret a value at risk of 1.3 million if I were to tell you this is credit risk? This is the 5% var and it's yearly data. 1.3 million. How would you interpret the 1.3 million of a value at risk based on annual data and 5% confidence level. That in 5 out of 100 years, you will have a loss that is higher than 1.3 million. So, every 20 years, you will have a loss of at least 1.3 million. And this is very important to remember the definition of a quantile. In practice, especially during the financial crisis, practitioners, bankers, usually misinterpreted the value at risk as in the following. The value at risk tells me in how many cases I only lose exactly 1.3 million. And during the financial crisis, I actually heard bankers in Germany complain and whine about, oh, why didn't quants tell us that one could actually lose more than the value at risk? Well, the mathematician will say, well, dummy, if the quantile is defined as the threshold which separates 95% and 5% of the probability, it only tells you that you will cross the threshold in 5% of all cases. The value at risk does not tell you anything how these losses will look like. It will only tell you that out of alpha percent, with alpha percent probability, you will have a loss that is 1.3 million or above. So be careful when it comes to value at risk. Many German bankers, well, many global bankers didn't quite get this. A quantile separates probability mass from probability mass, not losses from losses. And here you see the second disadvantage of the value at risk. It gives you an upper bound for losses, but it doesn't tell you anything how severe these losses will be in case the threshold is crossed. In practice, you will have confidence levels of 1%, 0.1%. The time horizon is often fixed to 10 days in market price risk and 1 year in credit risk management. By definition, the VaR does not allow any conclusions on the amount of losses incurred with probability 1 minus alpha. One needs to stress this. Bankers didn't get this before and during the financial crisis. They thought that what do you do with a value at risk? Quite simple. Banking regulation came and said, well, you have a portfolio. Your value at risk is 1.3 million. That is your exposure. Your exposure at risk is 1.3 million euros. And do you know what the Basel II banking regulation did? Very simplistically speaking. It said, dear bank, first calculate your value at risk. Take your value at risk. Times 8%. And that's your risk capital. Basel II demanded and mandated from banks that they calculate their value at risk, take the value at risk, multiply it with 8%, more or less, and what comes out of this calculation is the required statutory risk capital. If you nowadays hear that regulators argue that German or European banks have too little capital, this is what they mean. Not just equity, but risk capital in the sense that you take tier 1 equity, tier 1 capital, and you add some additional components of the liability part of the balance sheet, and you get regulatory supervisory risk capital. And the available risk capital can be seen on the balance sheet. The required risk capital is calculated under regulatory rules, and one rule looked like this: value at risk times 8% equals required risk capital. And You can change it to mean var, same, just take the var minus the expected loss. But from a statistical point of view, the valued risk is nothing but a quantile of the loss distribution. And that's the valued risk. Okay. I'll need a little bit more time to go through the generalized inverse and the quantile function. So I'll stop here. Do you have any questions regarding the valued risk or risk measurement and risk measure theory? No questions? No answers? So thank you for your attention and see you next week.